since it's just you and I, feel free to uh, bring up any topic on seller holds. I'll go ahead and pull this up because I definitely want to get you that website so you can go creep on that website, look for banks that are in the area where you want to do business, like where you live or in the state in which you live, or maybe even someone last month was trying to check out a state where they're planning to move, which is great. So some of this will be a review for you, but I do like to go over this stuff and particularly talk about calculating time value of money. That's such an important concept, and it's not just for people who are holding notes, it's also for others who have investments and all sorts of things. I mean, you got to be able to calculate and understand comparative yields to help you purchase investments that work for what it is you're trying to do. So one thing that came up to me when we had a most recent REI con was some folks didn't know what notes were, and that was my bad for not covering that. So I had to cover it in detail without any help from slides. And so these notes are nothing more than accounts receivable that consist of mortgage payments over a set period of time. Promissory notes spell out the terms of the loan, the interest rate, the amount borrowed, the late fee, and other terms. The deed to secure debt, that's what we call it in Georgia, but it has other names in other states, is the instrument that's filed at the county courthouse to announce the debt that encumbers the property and that the real estate is security for it. So why would somebody want notes? And so my take on notes is that I'm an active landlord, and that takes time and effort. Notes create solid yields in a low interest rate environment. With respect to defaulted notes, these numbers can be much higher than 8 to 20%. In fact, they often are. You can typically buy defaulted notes anywhere from 40 to 80% of their value because banks and individuals are motivated to move them because they're not paying. Why else would you want notes? Well, it's easy to understand. It's safe collateral, and you get to enjoy all the protections that the banks have, which in a nutshell is insurance, simple collection procedures that anyone can understand. Seller held notes, by the way, are exempted from this foreclosure moratorium such that it was, that has gone past us. Also exempted from the eviction moratorium because you don't have a rental relationship with somebody who's paying a note to you. Of course, you can hold these things in self-directed retirement accounts, and all of the IRA servicers, including Advanta IRA, which is one of our REI sponsors, as well as others, know exactly how to deal with these things. Now, one thing that they will not do is they will not take collections procedures for you, but they will let you know when something is not received or when it is. And in most cases, people will pay on time because it's typically the place that they live, it's their home. So people tend to be more motivated. And my favorite is that it's low level of time involvement. I can get yields that exceed what the stock market is. And if people, don't make payments, I may have a few things that I do, but I don't spend a lot of time with it. So it gets me closer to where I want to be with respect to passive income. Fully passive income is income you would never have to do anything for. You got to find these things and negotiate them, and follow a few simple procedures, as well as let folks know when they're late. But to me, that's no different than being a landlord. Very similar collection, and you just have to do it, right? You just have to do it. And people who are self-disciplined enough to be landlords can do this thing. It's a snap for that. So no considerations. Where do you want to invest? So Aileen, you talked about a note close to home. Where is home for you? For some reason I thought it was Virginia or Maryland. So did you say, are you in Virginia? Let me see.
Yeah, I'm in Virginia.
You're in, okay. Hey, Rebecca, you're in Wyoming. Wow. Okay, fantastic. So Aileen, you're in Virginia, and Rebecca's in Wyoming. That's fantastic. So what you want to do is typically people like to invest near where they live. That's fine, but it's an easy enough investment that you can invest across state lines. It's not that difficult. In fact, to me, I invest in Georgia, but the reason I invest in Georgia is not just because I live here, but because the laws are very tilted towards the landlords and by extension towards people who own notes. Economic considerations are important. Most parts of Virginia are growing, as are most parts of Wyoming for that matter. Not most parts of Georgia. There's a lot of Georgia that's not growing. And that's kind of important when you look at investing notes. You really want to look at the area that's where your note is going to be, because you can buy these things by the scads in areas of states, including Georgia, where the population is going down substantially, and so is economic opportunity. It's really important that you understand that. So I've got a question in the chat. I want to go over this right now. How do you structure these notes, legal entities, how to minimize your taxes on them? So these notes, you are purchasing existing loans. So these notes have already been structured for you in a very similar fashion. Like if you've ever borrowed money secured by real estate, that's about what these notes are going to look like. So you're going to have a promissory note that's going to list the party that's paying and the party that's receiving, along with the other terms and conditions. And then you're going to have a document that is basically securing it at your county courthouse. We call them a deed to secure debt in Georgia. They have other mortgage deeds, all kinds of security deeds, all kinds of other names in different states. Mortgage is how they're typically referred to. Let's see. So how do you minimize your taxes on them? So the taxes on notes are actually pretty easy to understand. So the taxes that you're paying are interest, because it's interest income. Is a passive income source, so there's no Social Security or Social Security or the Medicare taxes or any of that stuff. It's not earned income, it's passive income. So it is primarily taxed as interest income. And so your tax is already minimal. If it's a long-term asset, you're paying right around 15%. And 15% is about as low as you can get at the federal level. Can't advise you on your state level. In Georgia, it's 6% on earned income. It's actually all the same. We don't discriminate based on income. So it's 6% at the state of Georgia. So you have to take a look at your stuff. So yes, Rebecca, in Colorado, my gosh, everybody wants to live in Colorado. How fun is that, right?
You want to live in Colorado?
She lives in Wyoming. And so how do we structure legal entities? So we purchase notes through a limited liability company because they're easy to set up and easy to run. Typically, there's not much in the way of, there's really just very little legal liability to holding these notes. So you could hold them personally if it's something you wanted to do. A limited liability company is pretty easy to set up.
I'll put that in your name. Because the grower basically will pay your check to your name, so they know who you are. You don't want to do that.
I mean, that's up to you. What I'm saying is that it's a very low risk investment, and whether you decide, we do it through a limited liability company, but you don't have to. It's taxed the same either way. Although if you do it through a limited liability company, I should say that you do have additional tax reductions based on the 2017 Tax Act. Let's see. Wow, Rebecca, you do have a lot of people moving your way. So every state, most of the foreclosure laws are governed at the state level. So, and the primary difference is they're judicial and non-judicial states. So as you would guess, those that are non-judicial, you don't have to go to court to foreclose. And those that are judicial, you actually have to get a judge to check off on your foreclosure. So you will want to check that out.
Waste in your die? Are you like able after all those years to just?
Yeah, I mean, it's one of those things that I think Virginia is non-judicial. I don't know, but all you really have to do to find out in your state is punch in judicial foreclosure laws in Wyoming, foreclosure laws in Virginia, and you will get a nice Google those things, and you'll get a nice primer for what it is in your state. In Georgia, it's non-judicial. Takes about 60 days total to get it done. It costs about $1,500 soup to nuts in the state of Georgia. Seller-held mortgages are exempted from both the foreclosure and the eviction moratoriums, such that they were to begin with. Those things apply to those. The foreclosure moratorium applied to government-insured loans and loans for servicers that had over 5,000 loans. If you get over 5,000 loans in your portfolio, then you may have to hire an attorney to help you. Otherwise, I think you're in good shape as far as those things applying. So let's see. So we were talking a little bit about why notes. I kind of went over that. Let's see. So we talked about we talked about note consideration. So you definitely want to invest where the economy is good. And it's very easy to find out. For me, the surrogate that I use is citydata.com, and it will tell you if the population is rising, if it's increasing, falling, or if it's staying about the same. If the population is substantially decreasing, you may want to consider whether or not you purchase a note in that area. Only because there are areas of our country that people are rapidly moving from and not moving to. And that is an iffy environment for a note holder, because if you have to take that thing back, you got to ask yourself that question: would you want to own this property if it's pay or defaults? And if that answer is no, you should consider whether or not you want to purchase a seller home mortgage note in that environment. Mostly the answer, for me, the answer has to be yes. And if it's not, then I move on to the next one. But you also want to think about how do you want to invest in notes? Some people are all about the diversification. So I want one $100,000 note, 10 $10,000 notes, or two $50,000 notes. I will do those last two. I'm not typically looking to have one $100,000 note. Rebecca, that's interesting. You got lots of people moving your way from California. They certainly love the lower prices that they're going to enjoy when they get to Wyoming. And a whole lot of other things, a lot of freedoms that they long ago probably had to give up in California. No disrespect for California. It's a beautiful state. The mortgage foreclosures out there are a pain in the neck. They're judicial and they take a long time. So if you're going to invest in California, get the full skinny on it, because they still have moratoriums in place that the state has done on its own. So that's above and beyond what the federal government has done. And so you just, Rebecca said, and we have water. Yes, you do. So if you're going to invest in California, just beware. And the most important thing is that all this stuff is really done at the state level. State level, there are federal regulations that govern collections law, but primarily it's state regulations that govern foreclosure law, and which is kind of interesting. So it matters what state you're investing in. So another thing to consider is, has the payer been making timely payments? We typically ask for the last 6 months of payments just to verify whether that's payment deposits to a bank account, or they may have copies of the checks before they went in, or even if they get paid Google Pay or PayPal, they could show that stuff. Most times, I got to tell you, note sellers are very honest with you about their notes and about the people that are paying on them, which is nice. They will tell you if they have a problem payer. And so then you get to make that decision. Is that something that you want to pick up? My suggestion is that if you don't mind owning that house, that you might consider picking that note up and taking out the trash if you have to, right? So, but don't let it dissuade you from looking at it. So how long has the payer been making payments? This one's pretty important. If someone has been making payments for less than 6 months or maybe even a year, I feel a little uncomfortable with that, because I want people to be in the habit of making that payment and making that payment relatively timely. Either that, or I just have to acknowledge that going in and recognize that it could be a potential default situation. So you want to adjust the offer price based on the situation. So what is the investment to value and what equity has been created from paying down the note? You will know that because you're going to collect the information from the potential note seller to let you know how much of the principal balance has been paid down and what the fair market value of that home is. And of course, you'll want to check all this stuff out on your own. Do note sellers have to, I'm going to take this chat. Do note sellers have to pay tax on income from selling their notes? They are supposed to pay income tax on that. Whether they do or not, I have no idea. But it kind of depends, though, Rebecca. Let me back up just a minute on that. So it kind of depends. If it was associated with the sale of their principal residence, they probably do not have to pay taxes. If it was an investment property that they held and they sold the note, they probably are probably supposed to pay taxes. But there's not a reporting mechanism, and I don't report, and I can probably tell you that others do not either. So there's the technical, and then there's what really happens. So then you also want to think about what your desired yield is when you're looking at notes. And so for us, it's 15%. That's what we're looking for. That is attainable, but it's not readily attainable. You have to go through and work on that. So let's talk about sources of notes. This is it's kind of interesting because there's not exactly a clearinghouse of these notes. There are some outside folks that do sell them. And in fact, so if you want to market for your own notes, go to notesellerlist.com and they will sell you a list of people who have mortgage notes that were originated in the area of your interest. You tell them what you want. Size of note, where it is. I want my notes in Virginia. I want it in Loudoun County. I want it, size, 0 to 100,000, right? That if we're going to talk in a minute about a site called paperstack.com, PAPER stack, STAC.com. Jump on there. They've got notes for sale. Take a look and see what's available in your area of interest. Network on Facebook Marketplace and REI groups, Real Estate Investor Association groups. Very good place to find people who have notes. You'll find that real estate investors routinely take back notes and oftentimes are looking to sell those. Another one for defaulted notes is here's a government website where you can see, among other bank data, banks have to report how many notes they have, what it is they have, mortgages that they have, what percentage of those mortgage notes are in default. And you may want to go there and reach out to to the banks in the areas where you have interest in investing and see if they have any defaulted notes that they would be interested in selling you. You might be surprised. Banks sell those routinely, particularly where if they're loans that are not government insured. The government will make them whole once they present a note after a default event. But these banks also hold portfolio loans and other loans that they will not be made whole for. And as we discussed at the beginning, banks have to reserve the amount of money. So in other words, i.e. take it out of circulation for the number of defaulted loans that they have. So that is a big pain in their keister. Banking regulations prevent them from profiting from the sale of these things. So this is actually a pretty good place for you to reach out to a local bank that you have an interest in, find out what they have and shop. Go online and shop those banks. There's some banks that have basically no defaulted loans in their portfolio. So why would I contact them, right? For those that do have some, and you will be surprised when you go to this website, there are some banks that have 30% defaulted loans. Isn't that interesting? Now, you know, banking regulators are going to be all over those. So you wouldn't, if that was an area where you had interest in investing, it would not be a bad idea to call the asset manager there and tell them you have interest in buying notes, defaulted notes, right? They should welcome you, and it's a good place to pick up a note. You could shop these loans. Defaulted. Rebecca, are you saying? Rebecca, are you saying that defaultednotes.com will allow you to? Oh, very nice. Thank you. I'll take that. So Rebecca is referring to a site called defaultednotes.com where you can shop these loans. That's awesome. Thank you for bringing that up. I love that. So how are we doing? Do we have some additional questions? Let's see, here we go. I'm going to keep going. So one of the things I like to do every month is to go through a time value of money calculation because I think it's important. These calculators are $20 down at the Office Depot, or you can download an app. But whatever you do, you can download an app to your cell phone. Whatever you do, please get comfortable with these criteria so that you can evaluate notes as well as other investments. And so we're going to go through a calculation this month. I'm not going to take a long time with it, but I just want to make sure that people are familiar with this. So when you look at this calculators, these financial calculators, the most important things that you're looking at are those 5 keys down below, right across. Usually it's the second row there. And they are PV, which is present value. For our purposes, PV is the current mortgage balance. Future value, which is often going to be 0 if you're buying an entire note. N is a number of periods. That's months, typically for us, because our payments are over monthly time frames. Interest rate per period is, so that's the rate per month. This is where people usually kind of mess stuff up. They'll put in an interest rate per year, but what you do is you put in that yearly interest rate and then click divide by 12 and then input that into the I. And you have payment per period. And you're going to want to learn this operation because you're going to be pricing these things based on your criteria. Your criteria alone, but you want to understand what you're pricing, so you need to run through the calculations. You also want to compare it to the information that you receive from a potential note seller to make sure that it checks out. There are a number of note sellers that you will find that do not know their interest rate and maybe know their payment. You hope they know their payment. If not, you probably need to get a copy of the promissory note. Or you can make your offer contingent on those documents. So whatever it is, but it's important that you understand what it is you're looking at. So I'm going to go over one for a note in Carrollton, Georgia. And we're going to talk a little bit about this. So this loan was originated at 32,000, had 180 payments, so that's 15 years, a 6% annual interest rate. Calculate the payment first and then compare it to the promissory note monthly payment. Or if you don't have the promissory note, compare it to what the potential note seller tells you on the phone. And hopefully they line up. If they don't, we have some additional calculations that we have to work through. So input 32,000 into the present value because that was the balance when it was originated. Because right now what we're trying to do is extract the note amount. Then input 0 into the future value. Input 180 into N because there's 180 periods or 15 years. Input 6 divided by 12 into I. So we're taking that annual interest rate of 6%, dividing it by 12 to get a periodic interest rate. Must do that. Must convert that to periodic interest rate, not the annual, or you'll get some crazy number that will make no sense to you. But that's okay. When that number pops out, you'll remember, yeah, I need to go back and correct this. So hit compute for the payment and you get $270 a month. Now, so this helps going into a discussion with the seller. If you have some of this information, oftentimes your documents that are filed at the courthouse will have some or all of this information. Typically in Georgia, they'll have everything but the interest rate there. So sometimes you even guess at the interest rate. So you can ballpark an offer. So now you know what the payment should be. So now you want to see, okay, so if we got payments as agreed, in other words, if the payer is making their payments timely, you want to determine what the current principal balance of the note is after the most recent payment was made, because what you're doing is typically reaching out and offering to buy the remaining payments of a mortgage. Now there is you can also reach out and try to purchase a portion of the remaining payments. We'll talk a little bit about that. That's called a partial. But you can be as creative as you want to be. Typically, note sellers want to sell the whole note, not just a portion of it. But that doesn't mean you don't make the offer because they may have a different objective, and partials don't have to be discounted as much to give the yield that you seek. I mean, we could do examples of that and probably will in the coming months. So there are 124 payments total, and 74 have been made to date. And so that means there's 106 payments remaining. So you punch in 106 to N. So this thing is basically a computer. So when you punch in 106 to N, you're telling it, now I want you to take this calculation and I want you to give me the information based on the fact that I have 106 payments remaining. So you punch compute present value, CPT, which gives a present value of $22,124. And that's the remaining principal balance. So that is really what you are offering on to purchase from the note seller. So your next thing that you need to do is don't clear your calculator. You want to keep the remaining, keep everything that you got there. And so then you got the question to ask, what yield is it that I desire? Now, so let's say that you desire a 15% yield. That happens to be the one that we start with. Doesn't have to be yours. Do whatever makes you happy. Some people are happy with 10, 8, 6%, whatever. It's all good. So you want to determine what rate of return that you want. So what you're doing now is you're calculating the yield on the investment until maturity. Okay. So you punch in 15 divided by 12 in this case, because we want a 15% yield. To put that on a periodic basis, we have to divide it by 12. So that's 1.25. and then you punch compute present value. So based on that desired rate of return, that means you offer $15,712 for the note. Now, there may be other costs that you want to subtract from this offer. And there may be the fact that you want to negotiate from a position upwards. So you may subtract, say, so if we have to use an attorney to close a loan because we're purchasing something at a distance, it costs us $550. So I would probably knock off $550 from this amount when I went to them. Alternately, depending on what I thought the negotiation was be like, I might drop, a little bit more. Just kind of depends on where you're at. You got to feel that out, decide what your style is. But if you were just basing it strictly on the desired yield of 15% for this cash flow, you would offer 15,712. So keep going here. So suggested follow-up. If you have not purchased these before, I recommended earlier, and I still recommend that you go to paperstack.com and look and see what's available in your area. I also think you ought to reach out to that government website and see about negotiating for notes in areas where you're interested in purchasing from banks who happen to have defaulted notes. The other place to look is in public notices. You can call them and make offers on notes. I haven't found so much success with that here in Georgia, but it may be different somewhere else. So the period that something has to be advertised for something to be foreclosed is about 30 days in Georgia. So a lot of times, because of the health of the market, they may or may not look at an offer that you would give to them because they know they're going to be getting that property back anyway. Or depending on the robustness of the market, they may sell it off and get all of their costs paid at the courthouse steps when they auction that stuff. So that's my suggestion for you to look. Marketing, Facebook Marketplace has a residential note investing subgroup. Every once in a while I see deals come up on there, but that may be in your area. Take a look at those, see if that's something you'd be interested in. Doesn't cost anything to join. So there's notesdirect.com as well. There's all kinds of places that sell notes. My only issue with the websites is when you solicit private owners for notes, you typically get better yields. And what a great thing it is when you can be the first person to talk to somebody about selling their note, right? That first mover advantage is really hard to beat. And Rebecca raised her hand. Go ahead, Rebecca.
I thought maybe talking into the mic might be easier. I just have a question about what you're saying about buying notes. Let me make sure I understand that you're saying that if we reach out to maybe someone who owner finances homes or whatnot, and they might sell that note directly to us. Is that what you're saying, is just to purchase them from the individual who possibly did the note on a house that he owned, and then he wants to turn around and sell that note after it's, what do you call it, after it's seasoned or whatever?
Right. Yeah, exactly. I guess my only point is I love the websites, don't get me wrong. But when you deal direct with the note owners, you typically can get a higher yield and on better terms that you like. Doesn't mean that the websites aren't great for, finding notes and purchasing notes. I just have noticed, and I mean, it's what you'd expect, right? It's like buying a house that's on the MLS versus buying a house that you found, right? That you went out and you knocked on a door, and you might get better terms, or you might get a better financial deal on a house if you find it yourself, as opposed to going to the MLS where it's been exposed,
Yeah, that's why they say with wholesaling that you go directly to those that are not, they're off market.
Yeah.
Okay.
Exactly. Because and I mean, how good a thing it would be, Rebecca, if you were the first person to be able to tell somebody that, you can actually sell that note. It has value. You would be surprised how many people don't know that they can sell that note. And if nothing else, that's a public service because, there are a fair number of note holders where they're kind of getting jerked around a little bit, if you know what I mean, right? Like,
So you were saying about getting the interest rate you want. How can you negotiate that with the person who owns the note when they're charging a certain rate and it's in writing with their, with their agreement already that they have in writing with their owner?
right. So Rebecca, the way that works is that you're not negotiating the interest rate of the note with the person who's paying it. You're negotiating what you're going to pay for the present principal balance with the person that owns the note.
So
You're adjusting it
you're
indirectly.
negotiating so that they have their yield that they want, and you hopefully get what you want.
Yeah. So for instance, in our example right here, let me go back up here so I can kind of do a better job of making that point.
Okay, so
So-
I see the 6% there on there. That's what the note is that you're purchasing.
That's right. So it's important, but Rebecca, it's a great point. You don't have the ability to change the terms of that existing note.
Correct.
Okay? So the only thing that you can do is change how much you pay for it. So in our example, we looked at a present value of 22,124. And once we applied our desired rate, the amount that you would pay for that note balance is $15,712, which pushes the yield to you up to 15%. Is that kind of, you see how that works? And
Yeah.
banks do this all the time. I mean, on your personal house, I'm sure you've had your mortgage change hands from SunTrust to, I don't know, Bank of America to Wells Fargo, all these guys, right? They buy and sell these things by the thousands. Now, and a lot of it has to do for them is with their business planning, right? Because when you have a bunch of notes that you're servicing, they have to keep money. They have reserve requirements that they have to follow as well, based on a projected amount that'll be not paying at any given time, right? So this is nothing more than the seller it turned into the bank, and now they're wanting to sell this note because they're over making payments. So maybe the guy who gets the 15,000 wants to buy a boat, or maybe they just want to get out of the payment collection business, which is understandable. Go ahead, Rebecca.
I'm sorry, I have lots of questions.
Okay, that's what it's for.
Okay, so for example, we have a house that we would like to buy or take, we'd like to buy it, but the seller, who we know personally through some friends, he's already written an agreement with a lady to rent it. And it's got two properties. It's on one lot. So that's kind of normal here. People back in the day, they'd build a house and then they'd need a secondary home for mama or a secondary home for nanny or for whoever. And so they put a second house back in the back, and they allowed that back in the day. And so a lot of those are grandfathered in here.
Good.
So you have to drive down the alley to access the other one. So that one's rented out in the back. It's a little 2-bedroom, 1 bath. And then up front is a 3-bedroom, 1 bath, which they converted a garage and made it a 3-bedroom, 1.5 bath. So it's really nice little house, gets a good amount of income. So we'd like to purchase that, but Terry has already leased it out with an option with first right to the person to buy it who is leasing it from him. So is there a possibility that he could sell that agreement even though it's not really a note, I mean, it's a lease agreement, could he sell that agreement with us having the same agreement as he has, that we would sell it to her if she decided she wanted to buy it after she rented it for a year?
So Rebecca, help me to understand this a little bit, because
Okay.
so typically that transaction's done with two documents, a lease and then an option agreement.
Okay.
Did he put this all in one agreement?
I don't even know if he gave her an option agreement. It might be verbal.
Oh, shit. Sorry.
I know, I know, but that's how they do stuff around here.
That's okay.
It's by word, and it is kind of crazy. I mean, I would never want to do that either. It's not a great idea, but I could ask Terry whether or not they've done, if it's just a verbal, and he'd tell me whether or not it's a verbal. He's just a landlord in this area that's trying to get rid of everything he owns, fourplexes, and he's getting out of renting stuff here because they moved down to Cheyenne.
Okay. So I think the question there is, well, first thing is typically that transaction's done with a lease agreement and then an option agreement. They're two separate agreements. And the reason you want to do it that way is because your landlord tenant laws don't play well with your property ownership laws.
Okay.
Should somebody, the other thing is that one document typically refers to the other, so that if there's a default under the lease, the option agreement is negated, right? Voided is the legal word is voided.
Right.
At the same time, I don't think it's fatal. I mean, the real deal is to talk to the lady who's got the verbal option or whatever, and see what she wants to do. See if she has an issue with you having the ability to purchase it, or for you purchasing it. I mean, it may not be a big deal for her. She may not really want to own it.
I know. And I don't understand, but a lot of people say I've had homes down in South Texas where we used to live, and in California, where they say, well, we want to buy it after we've lived here a year or whatever. And then before you know it, they're leaving in 9 months or 8 months because their job didn't work out or something, whatever. And so, it happens. I understand that. But in this case, I just wanted to know. So if he has them separated, I could purchase his lease, because I think that's what the chances are more likely of, for her to come up with that down payment money and purchase that home at the end of the year, is not likely.
So wait just a second. Are you saying this has to be executed in a year?
No, I'm saying that,
okay.
I'm wondering if Terry could sell us the right. And if we bought it from Terry, if we bought the rental from Terry with the same agreement to her, that she could buy it if she wanted to within a year, because I don't think she is going to. So I'm willing to take the chance. I'm saying that if he has the two documents, if he has the one where he has the lease agreement, and then the other agreement that you're talking about, I call it right of refusal. What do you call it?
Call it an option agreement.
Yeah, an option agreement. So if he has that option agreement, and then he also has the lease in place. So he has a lease in place that it's up in a year. Basically she's out and he's going to sell it, or she's going to buy it. That's what he wants.
Okay. So I think that's good to ask, and I wouldn't dismiss the idea of talking directly to her and see if she would be willing to forego that. I do think that if you're going to enter into this agreement, you need a written agreement. The courts are full of these lease purchase type arrangements, which is what I call this stuff, of so-and-so said he'd give me an option. Well, it's not in writing, so it's really tough for a court to get in the middle of that.
Right.
And in fact, they won't.
Yeah, that's been really a thing around here that, I tell people all the time, like, did you get it in writing? I'm like, no, but he said, like, yeah.
I mean, that work, as long as everybody's on the up and up, it's no big deal, right? It's just when somebody doesn't come through with their perceived side of the bargain, or if something happens that's unforeseen. But
Right.
I don't think it's an issue, and I think that a dialogue with him would be helpful, and then a dialogue with her as well. Um, in most states, when you sell a house one to the other, that lease comes with the house. So in Georgia, when I buy a house, if there's a tenant in there that's under a lease agreement, that comes with the house. So
Right.
um,
But since he's given her, I don't know if it's been a verbal, like you said, that is a good question. I've got to get that answered, whether or not he verbally said he would sell it to her after a year. In other words, she has the first right to purchase it.
sure.
So if that's in writing and if she's okay with buying it from someone else, I don't know why she wouldn't be. As long as, we got it in writing and I would honor the agreement and she had a recourse. I don't know.
Yeah,
why she-
I think that's great.
Okay.
The other thing you want to check is that he got his lease agreement in writing. Have you seen that?
No, I haven't seen it. Terry's just, we do some things for him occasionally because he's down in Cheyenne, and if he needs something
Okay.
done at a house, he'll have us go by and show it, or lock it up or unlock it or whatever, just because we've known his daughter for quite a while, and I help her with the kids and stuff, and so we just kind of know them.
So my experience is, and Rebecca, there's no problem that he did or didn't. I mean, people operate different ways
I'm
all
pretty
the
sure he
time.
would put the lease in. I'm pretty sure he'd put that in writing.
Okay.
Because
So
he's
I-
been, like, he's a landlord. Around here, it's pretty typical. If you're going to give a deposit and such, you want to, get that in writing.
Oh, yeah. So you would want to take a look at that lease agreement,
Okay.
particularly to see if it refers to an option agreement, because if it does,
Oh,
then
okay.
you need to be aware of it. It's not a problem, right? I mean, it's never
Right.
a problem. If people can work together, it's never a problem. The only time it's a problem when you get into court and somebody did something or didn't do something, right?
Right.
So-
And you have three different individuals here, or three different parties, being us and Terry, and then the lady who's leasing the property. And then you also have the other lease agreement in the back. That one's leased out.
Right.
So you got four parties involved, sort of here.
Oh, yeah.
Four agreements.
That's right. So
can get kind of dicey.
it can get dicey, as long as
It
people
can
are
be
of
worked
goodwill.
out.
Yeah,
Right.
it shouldn't be terrible.
Okay.
I mean, and the other thing is, you and I know, so just so you know, if you don't, 80% of these lease purchase deals never go through.
I know that Terry knows that too.
Okay.
I knew by the look on his face when I talked to him on Saturday. It's like, Terry.
That's a problem. Nonverbals communicate way more than, I'm not even listening to you, right? I'm looking at you, right? I want to hear what's really going on.
Yeah. Yeah.
So he knows it's a promise, and he knows that it's not likely.
Yeah. I said, okay, Terry. I said, so you've told her that she's got the first right, and I'm second in line, right? And I looked at him, and he's kind of like, oh.
Yeah. So.
Yeah. So we'll see.
That's all right. Yeah, give it a crack. I mean, it's definitely worth pursuing, and
Definitely.
I don't honestly know if Wyoming it's such a cool place. I'm assuming it's non-judicial foreclosure, but I'm gonna let you figure that out. It's wild, wild west, right? So I mean,
Wild, Wild West.
it's way crazier than Georgia, which was started as a prisoner colony from Great Britain. So
Wow.
that's why we have the laws we do.
Well, I'm used to dealing with the laws in Texas. It's kind of like anything goes, whatever you put in a contract.
Yeah, now Texas is off the chain. I mean,
You can put anything in a contract. I learned that from my attorney there, my real estate attorney there. He's like, Becca, we're just gonna put that in the contract. I'm like, seriously, we're gonna put in the contract. He has to leave the tractor there for me. He's like, yeah. I'm like, oh man, let's do it.
That's awesome. That's
Yeah.
awesome. Well, I'm going to go ahead and wrap it up and say, guys, feel free to reach out to us. There's my contact information, website. email address. Happy to help you. We've got forms. We can send you forms to buy. Happy to help you evaluate whatever it is that you're looking at. It's a world of opportunity. And in 2019, there were over $20 billion of these notes originated. So they're out there. They're used in about 3% of transactions. So it's not a ton, but there's plenty. And so let us know how we can help you, and I appreciate your participation in this month's meeting, and I look forward to seeing you next month.
Thank you very much.
Thank you. Have a good one, guys.
Bye-bye.
Bye-bye.